to Trading Nation. I'm Mike Santoli. Stocks holding tight to record highs after a massive surge in the first 6 months. But our next guest says history suggests a painful pullback before the year is out. Ryan Detrick is senior market strategist at LPL Financial. He joins me now. So Ryan, most of the numbers when you've had a nice move in the first half of a year say, the rest of the year tends to be okay, but there's some wrinkles and caveats in there. So lay out what you found.
That's right, Mike. Let's not get too comfortable, right? First off, have a great July 4th holiday with everyone listening the rest of this week here. But you get to it. Mike, let's go to last year just for a second. First time since 1969 that stocks and bonds were down. Gold didn't do that well either. Now this year, everything's up, right? It's the best year in 20 years for stocks. Gold's making 6-year highs. Bonds obviously did really well the first half of the year. Big question, what's going to happen the rest of the year? Well, you look back in history at the S&P 500 when it's up 10% for the year, which obviously up 17% for the year at the halfway point this year. The rest of the year, it happened 20 times. The rest of the year is higher 16 times, up almost about 8% on average. Really strong returns. But Mike, where it gets a little worrisome is when you're up 15% for the year or more. So really stretched like we were. That's when you have an average return of about 3% the rest of the year, and that correction, the average correction, peak to trough, is about 12%. So you have a really good start to a year. Yes, the upward trend absolutely can continue, but let's not get too comfortable here. The odds of a correction, and during the scary third quarter that we're in right now, makes sense that we could get some type of a correction, maybe even as much as double-digit correction here when all's said and done.
All right, yeah, so obviously it sets you up for some kind of a payback. I'm wondering how sensitive this historical look is to, let's say, the year 1987 or some of these other dramatic singular moves that seem to skew the average.
Well, let's hope it's not 87, right? Remember, 87 stocks are about 40% for the year in August, but we do see some similarities like a lot of people talk about with 1998. 1998 saw almost a 20% correction, yet the second half of the year still was positive by almost double-digit returns. So we're not quite saying we're going to see a 20% correction. Maybe more like 10 to 15% is possible, but the likelihood again of that snapback rally is the fourth quarter. We all saw that scary fourth quarter, and then sure enough, 3-4 months later, making new all-time highs. Why is that? Well, people get so bearish and so scared so fast. Mike, it's fascinating. Just numbers came out. There are more money taken out of equity ETFs less money went into equity ETFs the first half of the year than went into bonds. More money in the bond ETFs than equity ETFs after a really good start to the year. So yes, that contrarian in us thinks this rally still has a ways to go. But again, after a big rally, we could be due for some type of a correction. And on that correction, at LPL Research, we're looking to get into those cyclical names, and we still like emerging markets. Those are two groups we think can really do well off of a well-deserved break.
Yeah, so it could be some kind of a shakeout that provides value for those who can play. All right, Ryan, thank you very much for joining us today. Appreciate it.
Thank you.
All right, and thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.